What if I told you that your retirement plan could be costing you $100,000 or more? And not because of bad investments or market crashes, but because of avoidable mistakes that most people don't even realize they're making. In this video, I'm going to break down the 3 biggest retirement mistakes that could drain your savings and show you exactly how to fix them before it's too late. Stick around until the end, because the 3rd mistake is one even financially savvy people make. Hey, welcome to What the Finance by RYSE Financial, where we bring you the latest in personal finance, the economy, and more. I'm your host, Prab, and let's get into it. Mistake number 1, relying too much on the 4% rule. The 4% rule is a classic retirement withdrawal strategy that suggests you can withdraw 4% of your portfolio annually without ever running out of money. It assumes a 30-year retirement horizon with a balanced portfolio of stocks and bonds. However, in reality, if you are planning to withdraw 4% of your portfolio every year in retirement, you might be setting yourself up to run out of money. The 4% rule was developed in the 1990s based on market conditions that don't reflect the reality of today's economy. With inflation, market volatility, and longer lifespans, blindly following this rule could leave you short on cash. When the 4% rule was created, the average retirement lasted 25 to 30 years. Today, people are living longer. A 65-year-old has a 50% chance of living past 85, meaning that their retirement would last longer than 35 years. A $1 million portfolio using the 4% rule would provide $40,000 per year, but that's before accounting for inflation, taxes, and unexpected expenses. Instead of blindly following the 4% rule, adjust your withdrawal strategy based on the following. Number 1, market conditions. Now, this may vary based on your portfolio balance and your income levels, but the rule of thumb over here really is, in bad years for the market, withdraw less to preserve your capital, and then in good years, you can withdraw a little bit more. Number 2, your actual spending needs. Instead of this fixed rate to follow, flexible withdrawal rates help ensure that you don't deplete your savings too soon. Number 3, tax efficiency. Strategically withdrawing from taxable, tax-deferred, and tax-free accounts can help you save thousands over time. So how would you go about fixing this? Working with a financial planner can help you create a customized withdrawal plan that adjusts to market conditions and also adjusts to your personal retirement goals. Let's move on to mistake number 2, ignoring taxes on retirement withdrawals. You might think your retirement savings is all yours, but the IRS disagrees. Most retirees underestimate how much they'll pay in taxes, and without a strategy, they could lose tens of thousands of dollars to Uncle Sam. And no, I don't mean the Uncle Sam that we saw at the halftime show.
It's your Uncle Sam!
So for example, a retiree withdrawing $100,000 per year from their 401k will be paying taxes on the full amount. So that could be anywhere between $20,000 to $30,000 annually, depending on the tax bracket. And then there's Social Security. Up to 85% of your Social Security benefits may be taxable if your income exceeds certain thresholds. And then, of course, we have RMDs, which are also known as required minimum distributions. RMDs force retirees to withdraw money from their tax-deferred accounts starting at age 73, often pushing them into a higher tax bracket. So retirement withdrawals are taxed differently based on the type of account that you're withdrawing from. So for 401ks and traditional IRAs, those would be taxed as ordinary income. Roth IRA withdrawals are tax-free, as long as you follow the rules and don't pull your money out before age 59 and a half and have held your account for at least 5 years. Brokerage accounts are taxed on capital gains, which, if you're holding long-term, are often lower than income tax rates. So the big picture is this: if you don't plan for taxes you could lose thousands of dollars unnecessarily. The goal is to withdraw strategically to keep your tax bill lower. So how would you go about doing this? One method that's popular with financial advisors is Roth conversion. Roth conversions are where you convert portions of your traditional IRA or 401k to a Roth IRA during low income years to lock in tax-free growth. So typically the lowest income years that you're gonna have in your life or career hopefully will be right at the beginning of retirement or right at early retirement. So what you want to start doing is looking at converting some of your traditional IRA or 401k balance into a Roth, because you won't be taking a ton of distributions. Therefore, you have a much lower income that will be taxed on. This means the tax rate for your conversion will also be lower. Another method that some financial advisors like is withdrawing from taxable accounts first. So this allows tax-deferred accounts more time to grow, which typically is what you want to do because you should have a higher balance in your tax-deferred accounts. And if that's not the case, speak to one of our advisors about maybe setting a time to create a financial plan for your success. And then another method that's really popular with people who typically have higher net worths is using qualified charitable distributions, or QCDs. If you're 70 and a half or older, donating directly from your IRA can help reduce your taxable income. All right, now let's move on to the final mistake, and honestly, potentially the biggest mistake, and that's mistake number 3, failing to plan for healthcare costs. Healthcare is one of the biggest, if not the biggest, expenses in retirement. Yet most people fail to plan for it properly. You know, it's tough thinking about your own mortality or you think that, you know, you'll be on Medicare and Medicare will cover a good portion of those expenses for you. But Medicare doesn't cover everything. You know, when you're working, when you're younger, you think that you're untouchable, or it's something that's just not gonna affect you, or it's far off in the future, so you're not worrying about it yet. And without the right strategy, you can end up paying hundreds of thousands of dollars out of pocket. Hundreds of thousands of dollars that you worked so hard to save and earn. Hundreds of thousands of dollars that you deserve to enjoy in your retirement. So, according to a 2023 study from Fidelity, a 65-year-old couple today will need roughly $330,000 to cover out-of-pocket healthcare costs. And then 70% of retirees will need access to long-term care, which can cost anywhere from $50,000 to $100,000 per year. And then the thing with Medicare is that there's also Part B premium increases, and those are based on how much income you have. So high earners will pay more for Medicare Part B premiums. So speaking of Medicare, it covers basic health expenses, but it leaves gaps in areas like long-term care. So if you need nursing or assisted living or, you know, home hospice, without long-term care, you just don't have coverage for that through Medicare. And then there's also dental, vision, and hearing, which are not covered by the original Medicare. And then there are prescription drugs, which they cover in Part D plans, but it varies like what they cover. And those costs can add up quickly depending on the kind of medication you need. Failing to plan for healthcare expenses could force you to withdraw more from your investments than expected, causing you to deplete your savings faster. So here are a few ways that you might be able to remedy this or fix this. One of the favorite ways amongst self-help, wealth gurus, and more importantly, financial advisors is to open a HSA, or what's known as a health savings account. If you're still working, it's one of the best tax-free ways to save for healthcare. It works by contributing your money pre-tax to an HSA account, and then you can withdraw those funds at any time tax-free for qualified expenses, whether that's deductibles, co-payments, insurance, or medication, you name it. Any unused funds and interest roll over year. You can actually use this as an investment vehicle while you're still working. When you hit retirement age, you've had this money that's accumulated and grown that you can now use for your healthcare expenses. Another thing that some advisors will recommend is purchasing long-term care insurance. Typically, long-term care will be added as a rider to life insurance policies. So if you're in your 50s or early 60s, securing a policy now can be far cheaper than waiting. The last thing to think about is reducing the amount you're going to be paying on Medicare IRMA surcharges. So Medicare IRMA, or IRMAA, stands for Income Related Monthly Adjustment Amount. There will be additional premiums for people with high incomes that pay for Medicare Part B and Part D. So reducing taxable income through Roth conversions and strategic withdrawals can help lower those costs. So in closing, these retirement mistakes are completely avoidable, but only if you take action now. So let's recap. Don't rely on the outdated 4% rule. Use a flexible withdrawal strategy. Don't ignore taxes on withdrawals. Strategically withdraw to minimize taxes. And finally, please, for the love of God, don't fail to plan for healthcare costs. Use HSAs, long-term care insurance, and Medicare planning. If you found this video helpful, hit the like button, subscribe for more, and share this with someone who takes their retirement planning seriously. Thanks for watching, and I hope to see you in the next one.